Now that we have labeled this circular flow diagram, we can look at measuring the size of the economy. So if you recall, there are two areas on this circular flow diagram where we can measure the size of the economy. That is, we can look at national income and we can look at GDP. National income is based on the wages, interest, rent, and profits, the money we make from selling our land, our labor, our capital, and enterprise. So this is our income that we have collectively within Canada. And this is then used to buy things or save or pay net taxes, and then gets used by other parties to buy goods and services, or by us to buy goods and services. So because of that circular flow, all of that income flows back to businesses in terms of buying goods and services. Now, it might change who's buying the goods and services. It might be the government, it might be other businesses, it might be households. But eventually all that money flows to businesses to buy goods and services. So that means that this national income here is equal to GDP. And remember, gross domestic product is the total value of all final products produced in a country in a year. So it's everything we buy. So we use all of our income to buy all the stuff, which businesses then use all that money to pay for land, labor, capital, and it becomes wages, interest, rent, and profits. So we get this circular flow, which means we can measure the size of our economy either based on our income or based on the value of what we make and sell. So we're going to look at this level about the size of the economy. There's an income approach, which looks at national income, and there's an expenditure approach, expenditure meaning spending, based on what is bought. And so that's the GDP. And GDP looks at who bought those particular goods. So when we look at the formula for gross domestic product, or the expenditure approach, we're looking at what do households buy, what do businesses buy, what does the government buy? What does the rest of the world buy? And we have to recognize that some of the things that households buy don't get made here in Canada. So we have to subtract away the imports. Some of the things the government buys, that businesses buy, also come from other countries, and so we have to subtract away the imports. But primarily when we look at import spending, it's coming from households buying foreign goods. All right, so let's start measuring the size of our economy. So based on that circular flow, we can measure the size of our economy using the income approach. Let's just get out of this red pen here and into a blacker one. All right, so we can look at the income approach. So we're looking at wages, interest, rent, and profits. We can also look at the expenditure approach. So it looks at who buys the goods. And in that case, we have our consumption, government spending, investment spending, and net exports, which is exports minus imports. Because what we make is what, in terms of income, is ultimately what gets spent in terms of buying goods and services, we can also look at the fact that when households get income, they spend it, save it, or pay net taxes. So in this case, all of these are equal. We can measure the size of the economy in terms of national income, the expenditure approach, which is what we're looking at, GDP, or by looking at what households do with their money, which is spend, save, and pay net taxes. So let's look at these each in a bit more detail and review what we talked about in the previous level. So if we are looking at the income approach for measuring GDP, we're looking at measuring national income. So we have to consider what income do we make from selling our land, labor, capital, and enterprise. So the W stands for wages. And if you think back to your factor payments, wages pays for what? Pays for labor. All right, then we have this I, and the I stands for interest. And which of the factors of production does interest pay for? It pays for capital. So we have wages for your labor, interest for capital. R is for rent. And rent pays for what? It pays for land, or those gifts of nature, those raw materials. And then finally we have pi, and pi is profit. And of course, this is how we will reward our entrepreneurs. Now you'll notice here there's something called an adjustment, and that's because when we look at the total amount of income, not all money that the business makes ends back up with households, right? They pay the workers, they buy machines, they buy the raw materials, they provide profit, but not all of that money gets redistributed back. So we have to account for that. So this adjustment here is any undistributed profits. So if we have a company that's just sitting on a bunch of cash and hasn't given it back to their shareholders or used it to expand the company, then that would be included there. When we have corporate income tax, this is the cost of doing business to a company, but it's not going back to the household. So there's a bit of that adjustment there. And then any depreciation on your capital expenditures. So that equipment, tools, machines, tractors that you buy will of course depreciate or lose value over time, and so that's part of that adjustment as well. So national income is wages, interest, rent, and profits, and then there's a couple extra things, but we don't need to worry about those. So we can take that income and we can spend it. So we have consumption spending. We can save it. And we can pay net taxes. And what were net taxes? Net taxes are taxes minus transfer payments. And of course, transfer payments are where the government pays you. So we only want to look at the money that goes to the government and stays with the government, not the money the government gives back to you. Now, we talked before about consumption spending, and see if you can remember what's included in consumption spending. So remember, consumption spending includes buying goods and services. And what were the three types of goods? We had durable goods. Those are the longest lasting, and the ones we cut back on first when the economy is not doing well. We have semi-durable goods. These are things that last about a year, so clothing, footwear. And then we have non-durable goods. And these are things we use up quite quickly, like food and gas. And then we have services as well. So let's look at our national income as a measure of GDP, and which of these, if we focus here on our factor payments, which of these do you think makes up the biggest portion of our gross domestic product? Well, here's the data for 2015, and what you see in terms of the total national income, over half of it is wages. Okay, about 17% is interest on capital, about 8.8% is rent on land, and then just under 12% is profit-based. And then you can see that adjustment is about 11%. So this is the national income approach to measuring GDP. Let's look at the expenditure approach. So the expenditure approach is based on who does the spending. So we're looking at consumption spending, which is spending by whom? Households. I stands for investment spending. And who is that? Businesses. And then G stands for government spending. And then our X minus IM, our exports minus imports, we call this net exports when you take your exports minus your imports. If your net exports are positive, so your exports are more than your imports, see if we can't get these words to come back. Technical difficulties here. Come on. Well, we'll reopen it. If your exports are more, now it comes back. All right, let's try that again. If your exports are more than your imports, let's go back here. If your exports are more than your imports, then that means that you're selling more goods to other countries than you're bringing in, which means there's more money coming in than there's leaving. So if your exports are more than your imports, your net exports are positive and you have a trade surplus. If your exports are less than your imports, then you're buying more from other countries than they're buying from you. Exports, the money comes in. Imports, the money goes out. So if imports are more than exports, you're going to have a trade deficit, and it's going to cause your GDP to decrease because money is leaving your country, not coming in. Now, as we look at the expenditure approach, C plus I plus G plus X minus IM, we need to just refresh our memory on what's included in investment spending. So do you remember what's included in investment spending? Businesses buying from other businesses. So we have residential structures. We have non-residential structures. We have the purchase of inventory and capital goods. So all that's businesses buying from other businesses. Well, we could look at examples. What do households buy? What do businesses buy? What does the government buy? And what do we export? Well, as we look at these components, which one do you think is the biggest piece? What is the biggest? So if we look at who buys the most stuff in Canada, is it households? Is it businesses? Is it government? Is it other countries? Well, if we look at the expenditure approach for 2015, we see that over half of what we make in Canada is sold to households. About 21% is sold to the government, just under 24% goes to businesses, and notice this net exports in 2015 was negative. So what does that mean? Do we have a trade surplus or a trade deficit? Well, if the number is negative, we have a trade deficit. Money is leaving our country. So which is bigger, exports or imports? If the money is leaving our country, then that's because we're buying foreign goods, and so the money is leaving, and we're doing more of that than they're buying from us. So we have a trade deficit. Exports are less than imports. We can actually look at what's happening in terms of today. So let's actually take a look. Let's leave this for a moment, and let's go to the Statistics Canada website. And we can actually look at the expenditure approach. Here's the 2016 data on the far right. And you can actually see how much is spent by households on durable goods, semi-durable goods, non-durable goods, services. So what you see here is all of the consumption spending. What you see below that in these sections here, look, here's the residential structures. Residential structures are here. Non-residential, machinery and equipment, that's capital goods. So what you see in that section is that investment spending. Okay, as we go down, here's our exports, and here's our imports. So we can see in 2016, we were importing more than we were exporting. so a trade deficit, just like we saw on the previous graph, where in 2015 we imported more than we exported. And we looked a couple levels ago about more current data. We looked at 2017. Well, where's the biggest growth in the size of our economy? So if we're looking at gross domestic product, which of those expenditures, C, I, G, or X minus IM, where is most of the growth coming from? Historically, consumption spending has grown from about 4.5% per year on average. Government spending grows about 2%, and business spending grows about 4.2%. Now, when there is a recession, one of the biggest challenges with a recession is consumer optimism and business optimism. If businesses are worried about the future, they are less likely to expand, less likely to get more inventory, more equipment, find another location. And so that impacts that investment spending and the level of growth of GDP. If households are not very optimistic about how well the economy is doing, about the income they're going to make, then they're more reluctant on buying cars, houses, things like that. And so we can see an impact as well on consumption spending. So what does it mean for the economy to be in equilibrium? So when we talk about the economy growing or shrinking, we need to look at whether that national income is equal to the expenditures. So you really can't change C plus I plus G plus X minus IM without changing wages, interest, rent, and profits. And so we'll look more about what it means for the economy to grow or shrink in the next video.